Yo, 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 yo. What's up? It's your boy Al Willoughby, Sir Willoughby, Stock Hustle on Twitter. Let's go. Today, we're going to get into the first lesson of basics of understanding the fundamentals of the stock market. So, this is for all my new investors, really my OG investors also. So, if you want to know how to build your foundation in the market, this is the key to go. We're gonna start with understanding the stock ETFs and their importance. Let's go. This is a guide for new investors. So everybody get your pens out, get your pencils out. Let's go ahead and get to work because you're gonna need them notes to be taking down those notes. And this is gonna be your foundation. All right, let me get me out the way. I understand the stock ETFs and their importance. The stock market, the stock hustler, motivation, dedication equals progression. That's our motto. So if you enrolled in the Stock Hustler University, motivation plus dedication equals progression. That's something we gotta understand. Without motivation, hey, you ain't even gonna get up and do it. Without the dedication to do the work, hey, you ain't gonna get nothing done. And if you don't see your progression, you're like, hey, I ain't moving nowhere. So you just gotta trust that process. Just dive into it. All right, the introduction. Investing in the stock market involves purchasing shares or ownership in publicly traded companies, with the exception of guaranteeing a profit. The stock market provides a platform for companies to raise capital by issuing shares, and investors can buy and sell these shares on stock exchanges. Here are some key points in investment options in the stock market. With these examples of the stock market, you can decide and choose which type of investor that you are. It's all types of investors in the market. You got your ETF investors, you got your retail investors, you got your company investors, you got your individual stock investors, you got your option investors, you got people who dividend invest. Let's dive into the next slide. Continue. Stocks, that's the equities. These are your individual shares. So investors buy shares of a company, becoming partial owners. Stock prices fluctuate based on the company's performance, market conditions, and investor settlement. So what that's saying, these are individual stocks. So this is like your Tesla, this is like your Apple, this is like your Coca-Cola, Procter and Gamble. These are just individual companies that you can just buy sole shares of. And they say, yeah, you become partial owner. Yeah, when you buy these shares, you are ownership. You have ownership in that company. You're a shareholder. But no, let's just get this to all my hustlers, man. I know I'm talking to some people from the streets. So let's just be real. You can't just go and take nothing from a store, or you can't just go and say, hey, I own Nike, so I should be getting a discount. I own this many shares of Nike. It don't work like that. But you do get say so and votes in where the company is headed, every quarter when they do earnings. But you can't do that. But you do own these shares. You only lose out on your investment if you sell these shares for a loss. If you keep these shares and you hold on to them and you're investing for your long-term performance, these shares, you will still have that ownership and you will build your share price in these your share count in these companies. All right, next we're gonna move on to bonds. Let's talk about bonds. The bonds are basically an older investment tool that a lot of businesses use. A lot of older people buy bonds. You hear about bonds from older people. The government buy bonds. So bonds, these are debt securities where investors lend money to a company or government in exchange for the periodic interest payments and the return of the principal amount of maturity. So what this saying is, hey, we ain't even tripping. We gonna give you $100 for such amount of bonds, and just pay me the interest every quarter, every year, um, and I can sell it in 10 years. But if I sell it before then I have to pay the taxes on it. So that's bonds. And you got your mutual funds. These are investment vehicles that pool money from multiple investors to buy diversified portfolio stocks, bonds, and other securities. Professional funds, money manager, mutual funds. So these funds are basically what you put your money in if you want a 401k. Hey, I got Fidelity managing my money for me, and I'm not even, paying it no attention. I just throw it over there. Hey, you do that for me. You do whatever you want to do. Just spread my money out and keep my money balanced. That's kind of on the safe side. And then you have your exchange traded funds, it's your ETFs. This is what I like to, I put majority of my money in ETFs, similar to mutual funds. But ETFs also hold a diversified portfolio of assets, but they trade on the stock exchange like individual stocks. So with ETFs, you can buy ETFs, but you also can trade options on ETFs also and make some money. You can buy whole shares of these. So ETFs is like a basket of the individual stocks. ETFs like a basket of these, a whole basket of these. So I got Apple, I got Tesla, Microsoft, and Nvidia. I got all these in one basket, and I'm just gonna go buy that. So I don't have to watch each one of these stocks. I can just see what my ETF do. Let's move on. All right, you got options and futures. Options and futures. This is what people trade. You hear people talk about day trading, that they trade options. So I made most of my money off of options. This is options and futures. This is the definition for it. These are financial derivatives that derive their value from an underlying asset, such as stocks. Options give the holder the right, but not the obligation, to buy or sell an asset at a predetermined price, while futures obligated the buyer or seller to transact at a future date. All right, so this is basically telling you, hey, we got 100 contracts. You can buy. We got 100 shares. You can buy a contract to purchase 100 shares. No, we're not gonna. We don't want these 100 shares, but we think that the share price is gonna go up to such and such amount at a such and such time, and or on the opposite side, we project that the price is gonna go down at a such and such time to a such and such price. So it fluctuates. You make money go up or down. Options and futures are highly risky. They're highly risky if you don't know what you're doing. But we building up the options course, so just dive over in there and take the first two lessons that we got in there. We got your real estate investment trust. These are your REITs. These are the companies that own, operate, or finance income generating real estate. Investors can buy shares of REITs, providing them exposure to the real estate market. So hey, if you don't want to, you want to get in real estate, but you don't want the risk that come with managing the property. You don't want the risk come with trying to collect rent or having to rebuild a house, or hey, just go buy some REITs. Whatever REITs you want in your field, you can get personal, residential REITs, and you can get mostly what big REITs are. Their company, commercial real estate REITs. So you can make money in the real estate market, on the stock market, also with REITs. You got your dividend investment plans. That's your DRIPs. Investors can use DRIPs to automatically reinvest cash dividend received from stocks back into additional shares of the same stock. So let's say if I got Coca-Cola, I've been owning Coca-Cola for 10 to 15 years. Coca-Cola pays me a dividend, and we're just hypothetically saying, I don't know, I don't have it in front of me, but hypothetically saying pays me a dividend from, you know, 25 cent to 50 cent per share. And I get that paid out to me per quarter. So instead of me getting paid that and put in my pocket, I'm getting that reinvested back into the company to buy more shares. So that's drips. That's a definitely. I've always put my ETFs on drips. I don't want my dividends to my dividends are paying me a good substantial amount of money at the quarter. You got an individual retirement accounts. That's your RAs and your 401ks. These are retirement accounts that may include a variety of investments like options, including stocks, bonds, mutual funds, and potential tax advantages. So we all pretty much know about 401k. If you don't have a 401k or Roth IRA, I advise you, to look into it to get one. Everyone needs one. It is crucial for investors to conduct thorough research, consider their risk tolerance, and have a well defined investment strategy before participating in the stock market. Diversification, understanding financial goals, and staying informed about market trends are essential components of a successful investment approach. So it is crucial. It is crucial. If you don't understand the risk ratio in the stock market, I suggest you need to look a little bit more. I'm not your financial advisor. I can't tell you to buy, hold, or sell any individual stocks. I can't tell you to buy or sell any ETFs or options. Anything that I say or bring is my opinion, it's my knowledge that I have in the stock market. Also, it's my buys and my sells. So do your own research. When I give you these, that's even on Twitter. So if you go to Twitter and you looking at some like CNBC, you even got to fact check them. Just do your research. Just hey, somebody say this company does this, it's finna do that. Go look it up. Only take you 5 minutes. That's how you're gonna protect yourself. Moving on. What is a stock ETF? An exchange traded fund is like a basket of different investments, such as stocks or bonds, that you can buy and sell on a stock exchange. ETFs allow investors to own their diversified portfolio of assets without having to buy individual investments separately. They are traded throughout a day on the stock exchange, just like an individual stock, making them a convenient and flexible investment option. Key features for ETFs: diversification. ETFs typically hold a diverse range of assets. The liquidity. ETFs can be bought or sold on the stock exchange throughout the day. So hey, if I don't want it and it's dropping, I can sell it if I want to. I don't have to. Don't go to low expense ratio. The significance of the low expense ratio results in cost efficient investing as investors pay less fees, allowing them to retain higher percentages on their investment returns. Overall, these factors make ETFs an attractive investment option for many investors seeking diversification, liquidity, and cost efficiency in their portfolios. Oh, my bad. All right. We're going to talk about a few ETFs real quick. We're going to start with the VOO, the VTI, and the SPY. The VOO and the VTI are truly, honestly, my two favorite. I have a few more that I will bring on. I will discuss. I'll drop them in the watch list also. But we're gonna talk about Vanguard. Vanguard, that's the VOO. VOO aims to track the performance of the S&P 500 index, which represent 500 of the largest publicly traded companies in the United States across various sectors. As it mirrors the S&P 500, VOO provides exposure to a broad spectrum of large cap. So we're going to talk about, when I say large cap, we're talking about your big mega companies. We're talking about Apple, Tesla. We're talking about the multi-millionaire company, Amazon. We're talking about big companies. VOO is basically the whole market in one. Vanguard is known for its low cost structure, and VOO maintains a low expense ratio. So you can get in where you fit in at the on the VOO. I like the VTI. VTI is the Vanguard Total Stock Market ETF. VTI seeks to track the performance of the CRSP, that's the U.S. Total Market Index, covering the entire stock market, including large cap, mid cap, small cap, and stocks. So if you just don't want to, you don't want to just do the VOO, you're like shit. I want to do the VTI too. I just want the VTI. I just want to buy everything. Just buy the VTI, and you got the whole stock market in one basket. So whatever the American economy is doing, that's what you're doing. If the American economy is falling, you falling. If it's rising, doing good, you doing good. So diversification, VTI offers broad market exposure encompassing stocks of all sizes and sectors, providing a more comprehensive representation of the U.S. equity market. VOO VTI is managed by Vanguard. VTI is known for its low expense ratio, making it a very cost efficient for investors. VTI is not that expensive, like 248 right now per share. It's an amazing investment, but you can buy a fraction of shares of these, you guys. You can buy a fraction of shares. So I always remember that. We'll talk about the SPY. The SPY, that's the SPDR ETF Trust. The SPY is one of the oldest and most widely traded ETFs designed to track the performance of the S&P 500 index. SPY is high liquid and is one of the most actively traded ETFs on the stock market. Issued by State Street Global Advisors. SPY is one of the Standard and Poor's depository receipts. Standard and Poor's talking about just S&P 500. Well, while it historically had a slightly higher expense ratio compared to the VO, it still remains very competitive. Investors often choose between these ETFs based on their specific investment goals, preferences, or diversification and cost considerations. Each of these ETFs provide a convenient way for investors to gain exposure to a broad range of U.S. stocks. I love these because, hey, I don't have to worry about them. Anything doing good, everything's doing good. I don't have to. Um, if Apple's falling, I ain't got to worry about selling Apple because I got something in my ETF that's gonna pick me back up, also and balance me out. So I love ETFs. We do $25 a week in those. All of my portfolios, I have an ETF that I invest in. The importance of investing in ETFs, automatic reinvestments. Like I was just saying, $25 a week, automatic reinvestments on your ETFs are amazing. You just set it and forget it. $5 a day, you can do $10 a day, whatever fits your um your 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 situation. You can do $50 a day, $100 a week. You can do whatever you want to do. But I suggest everyone, in my opinion, it's not financial advice, but I suggest to everyone to invest solely in ETFs. Automatic, set it and forget it. It's like a savings account. Benefits some of the ETFs offer are the automatic dividend reinvestment plans, allow investors to reinvest their dividends back into additional shares of the ETF. So hey, Apple pay out 25 cents a share. Um, hey, I want it. I want to reinvest it. So 25 cents a share, that's $1 a year. I got a lot of shares. Say I got 50, that's $50. I'm investing back into the company to get me more shares, to pay me more dividends. So that's lovely. Impact this feature facilitates compounding returns over time. The compound effect is very strong, you people. People, we got to understand the compounding effect is very strong, and compounding returns over time, potentially enhancing the overall performance of the investment. For new investors, the combination of diversification, liquidity, and cost efficiency and accessibility makes ETFs a compelling choice as they begin building their investment portfolios. This is the first thing you really need to buy. You don't need to go out and buy nothing high risk if you jumping in the market and you don't know what you're doing right now. Just if you just eager to spend your money in the market, put it on the ETF to just start understanding how the market just fluctuates, how you can get in or you fit in. Additionally, the transparency and variety of investment options provide valuable tools for learning about different asset classes and investment strategies. Safeguard for growing wealth. Investing in ETFs like VOO, VTI, and the SPY can act as a safeguard for watching your money grow through various mechanisms, including historical performance and long-term potential growth. Let's talk about the historical performance of the ETFs. The steady growth, historically broad market, ETFs tracking indices like the 500 and the total U.S. stock market exhibit steady growth over time for long term market trends. These ETFs tend to capture the overall uptrend of the stock market, reflecting the growth of the overall economy. So with these, you're steady growing. America is always steady growing. Things are steady getting expensive. We're always steady consuming. So if the market's steady growing, we know if our money is in these ETFs, our money is going to steady grow with America. If that makes sense to you. Drop some in the chat if it makes sense to you. It's important to know while historic performance can provide insight, it's not guaranteed for future results. Nothing's guaranteed in the stock market. Anybody tell you it's guaranteed in the stock market, anytime somebody tell you anything is guaranteed, run away. Run away because it's not nothing's guaranteed. But life and death. So markets can be subject to volatility and individual investors' experience may vary. Understanding your investment goals, risk tolerance, and maintaining a long-term perspective are crucial when investing in ETFs or any other financial instruments. Additionally, seeking professional financial advice can help tailor your investment strategy to specific circumstances. Conclusion. Stock hustler rules. And I'll pull up a picture of this in a second. ETFs should make up 70% of your portfolio. I highly recommend not to put money you need into the market. Only invest what you can afford to lose. Write that down, people. That's just crucial. This is crucial. I highly recommend not to put money you need into the stock market. If you think you're going to lose, and if you just need it like in 3 days, I mean, we all need the money, but if you need it in 3 days, don't do that. Don't do that. Don't do that. I highly recommend not to put money you need into the stock market. Only invest what you can afford to lose. $50 you can afford to lose. Hey, that's what you put in the stock market. 100,000. If that's what you can afford to lose, that's all you put in the market. DCA dollar cost averaging. When you DCA into the market, you protect your money. I challenge each investor to start with $25 to $50 a week investing in the ETF of your choice. We're gonna start the challenge in the Discord today. I will put the ETF that I'm investing in. You guys can do that one, or you can pick your own from the list provided. DCA dollar cost average when you enter the market. So that's saying I'm doing $25 a week, like I just said, $5 a day, I'm doing $10 a day, whatever that equals up to at the end of the week. I get paid bi-weekly, doing $100 a week, every 2 weeks, doing $50 every 2 weeks, however you feel comfortable, whatever you feel comfortable with investing in the market. Remember, while the world of investing may seem vast, taking the first step with ETFs can make the journey more manageable and rewarding. Conduct thorough research, understand your risk tolerance, and consider how ETFs align with your financial goals. As you embark on this exciting venture, know that learning and growing are integral parts of the process. Happy investing. Okay. So I hope that made sense to a lot of people. Um, Me solely 70% of my money are in ETFs. I'm gonna pull up. Give me a second. Let me pull something up so I can show y'all the law. Y'all need to know the law. Give me 1 second, y'all. Yeah, so I hope that made sense. ETFs are the most safe thing to put your money in if you're looking to get into this market. Can't find it, y'all. I can't find it. Can't find it. Oh, let me see. This might be it. I don't think I named it. This it. That's not it. I'm still here. I'm still here. I'm trying to find the law for you guys. Well, if I can't get it, just know I put it in the. It's gonna be in the Discord. Don't even trip. It's gonna be in the Discord, but it should be make up 70% of your portfolio. Hope you guys enjoyed this, and I hope it made sense. Let's go. Invest wisely.